Unraveling the 2008 financial crisis. What really happened? The 2007-2008 financial crisis has been building for years. By the summer of 2007, there were indications on global financial markets that the years-long glut of low-cost credit was finally coming to an end. The British bank Northern Rock was going to apply for emergency funding from the Bank of England. Two Bear Stearns hedge funds had collapsed, and BNP Paribas was alerting investors to the possibility that they might not be able to withdraw money from three of its funds. Nevertheless, few investors realized that the world financial system was about to be engulfed in the biggest crisis in almost 8 decades, which would bring Wall Street's titans to their knees and start the Great Recession. Thousands of common people lost their homes, jobs, or life savings in a historic financial and economic catastrophe. Financial institutions were left holding nearly worthless investments in subprime mortgages worth trillions of dollars when the bubble broke. The 2008 financial crisis. What caused it? The cheap credit and loose lending rules that drove the housing bubble in 2008 were the root causes of the financial catastrophe. The banks were left with trillions of dollars worth of worthless subprime mortgage assets when the bubble broke. Many of them lost their homes, jobs, and savings in the ensuing Great Recession. Planting the crisis's seeds. Years of extremely low interest rates and lax lending regulations sowed the roots of the financial catastrophe and created a housing bubble both domestically and internationally. It started with good intentions as usual. Amidst the collapse of the dot-com boom, several corporate financial mishaps, and the terrorist attacks of 9/11-2001, the Federal Reserve reduced the federal funds rate from 6.5% in May 2000 to 1% in June 2003. The intention was to stimulate the economy by providing consumers and businesses with cheap money. As a result of borrowers taking advantage of the cheap mortgage rates, housing values began to rise. Even individuals with little or no credit history or subprime borrowers were able to fulfill their ambition of owning a house. Subsequently, the banks sold those loans to Wall Street institutions, which bundled them into financial products marketed as low risk, like mortgage-backed securities and collateralized debt obligations, CDOs. Subprime loan origination and distribution quickly grew into a sizable secondary industry. In October 2004, the Securities and Exchange Commission, SEC, loosened the net capital requirements for 5 investment banks: Morgan Stanley, Merrill Lynch, Lehman Brothers, Bear Stearns, and Goldman Sachs. This move encouraged banks to take on more risk. They were able to leverage their initial investments up to 30 or even 40 times as a result. Is the 2008 financial crisis in the past? The crisis must be seen as a critical turning moment in the history of our present, not history in the sense of a bygone era. Most commentators concur that it is safe to conclude what the short and long-term effects of the financial crisis were more than 10 years after Lehman Brothers' demise. There seems to be an infinite number of books discussing the reasons for the financial crisis and the ensuing Great Recession and its aftermath. Economists, journalists, and political analysts dominated the book market for many years until Adam Tooze produced the first thorough historical account in 2018. This massive book methodically recreated internal discussions and decision-making in central banks, governments, and international organizations, in addition to providing a deep examination of the financial catastrophe itself. Tooze highlights the crisis of revolutionary potential as well as its broad global geopolitical, military, and economic ramifications. From this angle, it appears like we are still dealing with the crisis aftershocks. The direct consequences of the macroeconomic downturn proved to be more severe and are being felt today, even though the immediate one was resolved rather quickly. Although stock market values have increased, the effects of 2008 are still felt throughout the global financial system, particularly in the banks. Even with the implementation of new prudential financial supervision and regulation tools at the national and international levels, many significant commercial banks are still undergoing restructuring and consolidation. Public debt has grown as a result of expensive rescue plans and expansionary fiscal policies, and the issue of who will pay for the disaster remains contentious. For a very long time, the politics of austerity will be crucial in many nations. There are now significant political and economic divisions across European member states and regions as a result of the euro crisis. Economic and social convergence have long been linked to European integration, but since 2008, this relationship has flipped. Growing economic and social inequality is not just a problem in the European Union, EU. Other regions of the world are also experiencing it. The aftermath of the 2008 financial crisis can be partially blamed for the rise of populist movements with protectionist agendas. Authoritarian solutions have frequently resulted from the augmentation of executive power. Indices of problems. Homeownership eventually reached a saturation point and interest rates began to rise. In June 2004, the Federal Reserve began hiking interest rates. 2 years later, the federal funds rate hit 5.25%, and it stayed there until August 2007. Early indications of distress were present. Homeownership in the U.S. reached a peak of 69.2% in 2004. Then the first part of 2006 saw a decline in house values. This truly put many Americans through misery. The value of their houses was lower than what they had paid. Without having debts to their lenders, they were unable to sell their homes. Their expenses, if they had adjustable rate mortgages, increased in tandem with the decline in the value of their houses. The subprime borrowers who were most at risk were obliged to pay mortgages that they couldn't initially afford. One subprime lender after another declared bankruptcy as 2007 began. More than 25 subprime lenders failed in February and March. Subprime loan specialist New Century Financial declared bankruptcy in April and let go of half of its staff. When Bear Stearns ceased accepting redemptions in 2 of its hedge funds by June, Merrill Lynch took control of the firm's $800 million worth of assets. These two were insignificant issues in the grand scheme of things to come. August 2007, the cards are falling. By August 2007, it was clear that the subprime crisis was beyond the financial market's ability to resolve and that its effects extended far beyond the boundaries of the United States. Fear of the unknown had a major role in the complete freeze of the interbank market that moves money around the world. A liquidity issue forced Northern Rock to request emergency support from the Bank of England, the first big bank to disclose losses, $3.4 billion. From subprime-related assets was UBS, a Swiss bank, in October 2007. The global credit markets were coming to a complete stop as asset prices collapsed, and in the upcoming months, the Federal Reserve and other central banks would make a concerted effort to inject billions of dollars into these markets. Financial institutions, meanwhile, found it difficult to determine the worth of the toxic mortgage-backed securities worth trillions of dollars that they had on file. Bear Stearns' demise in March 2008. By the winter of 2008, the global stock markets were plunging to their lowest levels since the terrorist events of 9/11/2001, and the U.S. economy was deep in recession due to the ongoing liquidity issues of the financial institutions. To stem the decline in the economy, the Fed reduced its benchmark rate by 0.75% in January 2008, marking the largest reduction in 25 years. The negative updates were coming in from every angle. The British government was compelled to nationalize Northern Rock in February. Bear Stearns, a 1923-founded Wall Street mainstay, was a global investment firm that failed in March and was bought by J.P. Morgan Chase for pennies on the dollar. September 2008, Lehman Brothers collapse. The banking sector was experiencing widespread carnage by the summer of 2008. The 2 largest home lenders in the nation, Fannie Mae and Freddie Mac, had been taken over by the U.S. government, and IndyMac Bank had become one of the biggest banks to fail in U.S. history. The fall of the Wall Street giant Lehman Brothers in September, however, was the worst bankruptcy in American history and was seen by many as a representation of the destruction brought about by the global financial crisis. Financial markets were in free decline the same month, and the main U.S. indices saw some of their greatest losses ever. Congress, the White House, the Fed, and the Treasury Department all found it difficult to present a cohesive plan to stop the bleeding and rebuild trust in the economy. The fallout. The first week of October 2008 saw the approval of the Wall Street bailout plan. Numerous initiatives were included in the package, including a sizable government acquisition of toxic assets, a large investment in bank stock shares, and financial support for Freddie Mac and Fannie Mae. Widespread public outrage was evident. It seemed like the bankers who had so heedlessly destroyed the economy were getting away with it. However, it restarted the economy's growth. It should be mentioned that the government fully recovered its investments in the banks plus interest. After the bailout package was passed, the stock market stabilized and went on to experience their longest bull market ever, which began in March 2009. Nevertheless, there was a great deal of pain and economic loss. The jobless rate rose to 10%. Foreclosures cost almost 3.8 million Americans their homes. Regarding Dodd-Frank. The Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in 2010, was the most comprehensive and contentious effort to ensure that anything similar would not occur again. In terms of finance, the legislation enhanced government supervision over the operations of the largest banks, prohibited some of their riskier ventures, and mandated that they have bigger cash reserves. It made an effort to lessen exploitative lending for consumers. Who's to fault for the current Great Recession? Numerous economists attribute a large portion of the problem to loose mortgage lending regulations that enabled many borrowers to take out much larger loans than they could afford. However, there is much blame to be assigned, such as the unscrupulous lenders who promoted homeownership to those who were unable to repay the mortgages they were given, the financial wizards who purchased those subpar mortgages and bundled them for later sale to investors. Those mortgage packages looked safe since the rating agencies gave them excellent investment ratings. The investors who only made sure to sell the bundles to other investors before they burst or who neglected to look at the ratings. In summary, there are always bubbles in the financial sector. Any commodity, including stocks, can see price inflation that exceeds its true worth. Usually, only a small number of overly eager customers suffer losses. The 2007-2008 financial crisis was a distinct form of bubble. It was one of the few in history to grow to such a size that when it burst, millions of people were harmed, including many who were not investing in mortgage-backed securities. It also devastated entire economies. So this is the end of our video. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.